All right, so we started off a very big week with a small inside boring day today. But again, don't get caught up in the boring. There's a lot to do, a lot to talk about. So I'm going to break down what the technicals are showing us heading into this important week. Also, remember there's a link popping out right there in the top right corner of your screen. That will click on that link. You can subscribe to our website at marketscholars.com for free with that link. That will give you access to our special Market Outlook webinar that we're doing this Wednesday night at 8 o'clock Eastern, 5 o'clock Pacific. I'm going to go over how the markets respond to the FOMC's interest rate cut decision this week, and then what we can expect to see going forward into the end of the year, and based on what we've seen in the past, how we should manage our portfolios, and give you some ideas in that regard. So tune in to that webinar, and to do that, subscribe to our site with that link I showed you. And let's go ahead and get started with our video today. Today is Monday, July the 29th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. And you can see how we continue to have strong bullish posture, a little bit of a decline today, a little bit. You can put a grain of salt because first of all, last Friday's range, was about average, and today's range was completely inside. So an inside day with a very small range. I actually saw one person equate today's pullback to June the 3rd's pullback, and it's like, whoa, wait a minute! Like we cannot have one down day without looking at it compared to that decline. It's like, come on now, it's a Now, granted, we have had quite a few down days here. 1, 2, 3, 4, 5 out of the past 1, 2, 3, 4, 5, 10 days. So, half and half. And as a result, we've been pretty flat. We started that we finished before that 10-day run at 30.14, and we're closing the 10-day run at 30.20. So we're just kind of flat to up a little bit. But the near-term line turned up again. The momentum line dropped, but not to a bearish low point. So that's not a big issue. That's a good sign. This is a good combination to have the near-term and intermediate lines in the upper reversal zone, and of course, dark green shading, rising green line, rising long-term market sentiment. Now, you'll notice that we are getting closer to that moving average. So, we can bounce off of it like we did here, or more likely start to have more of an intermediate pullback. Now, that's not imminent. I don't think necessarily it's imminent. Remains to be seen what happens this week, but we are getting closer. We've moved away from it. We are getting closer to it. We might pull a little bit below it. And get a 3 red arrow signal, whatever the signal is. But that doesn't mean that has to start immediately. We can continue to grind along a slow moving average to the upside. Especially when you have, like I said, rising long-term market sentiment that's still not in the upper reversal zone yet. Let's take a look at some of the other indexes. The Dow Jones looks very similar. Its near-term, it has been underperforming of late. It still hasn't produced a new high here for a couple of weeks, whereas the S&P's produced a few. The near-term line did drop into the lower reversal zone and produced kind of a neutral near-term low point, considering that we're about equal here. We're really going sideways. The NASDAQ composite has been trending upwards, so it was more bearish today. It's got the higher beta. It's been driving a lot of the price action. But still, despite that, the move off the low of the day today brought the near-term line up instead of down, which is where we were earlier. Momentum line still down, but not very much. And then finally, the Russell 2000. Still strong bullish posture, rising long-term market sentiment, rising green line, we're above it. But you can see how, these two up days notwithstanding, we're still unable really to get going. Break above 1600, stay above 1600, and now the Russell's 2000 is going. But if the dollar continues to rally, and this ends up being kind of a late stage market cycle, then we might not get significant outperformance from the Russell 2000. You tend to get that more when you're coming off of major low points. We're not necessarily coming off a major low point. We're kind of breaking to new highs and extending a bullish run that's not necessarily mature yet, but obviously is in the process of maturing. So we might not need it, but as long as it maintains bullishness, which, despite it being as flat as it is, you still have the those three signals: the dark green shading, which means you have a strong intermediate posture; the rising green line, which means we're trading above a rising 6-week moving average, and the rising market sentiment down here at the bottom in the orange line. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Click that red subscribe button that pops out. That notifies you when these videos are posted. Hit the thumbs up icon down below. That tells us you like the video. You want us to do it again tomorrow. Quick way to give us feedback. You can do that right now while you're watching. Also, comment on the video. What did you get out of it? People that come to us for the first time, let them know why they should be watching and what they can get out of it as well. Join our daily Market Outlook email list. There's a link popping up, top right corner of your screen up there. Click on that link to subscribe. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook community that we've created on Facebook. Also, if you're watching this on our blog, we invite you to subscribe to our website for free. You can do that for free just at the top of the page. Click on that blue button that takes you to our subscribe page. Remember, that will get you access to our online webinar that we're doing this Wednesday. Again, if you click on here on trading rooms, you'll see our full calendar of classes that we have with our upcoming events over here on the right. But you'll also see our webinar listed right here for Wednesday. So you only have to you can subscribe for free to our site to get access to that one. All the rest of our classes, of course, are for our premium subscribers. We'll have some more details on that here in the next couple of days as well. But that gets you access to that. We also ask that you engage with us on social media. The more that you engage with us on Twitter and on Facebook, the more they will show you our content that we put out there. So we try to make it really easy for you. Just click on this heart. That opens up a new window, and you can like today's Market Outlook tweet there. We almost got to 100. 5 short on Friday's video, so let's see if we can't get that up to 100 today. Again, the more you engage with us, comment, retweet it, like it, the more Twitter's like, hey, they want to see David's stuff, so they'll keep pushing you my stuff, Brandon's stuff, Market Scholar stuff, because we engage with each other so much. Same thing with Facebook, and there's the easy way to get to your Facebook post, today's Market Outlook Facebook post, by just clicking on this image here. And you can also like our blog post on our blog at Market Scholars by clicking on that like button. As well as see some other posts that we've put out here recently. All right, now let's get back to the charts here and take a look at the long-term chart. And you can see, because of, again, how we finished last week, that started us off with a pretty decent bullish candle this week. Even with this pullback we had today, again, to get a lower shadow to form, we'd have to get down below the low, which is also the open, at 29.92.95. And we're at 30.20. So that perspective, right? It's a little bit of perspective there. Momentum is still rising, which means the 50-day is still pulling away from the 200-day moving average, which is the case when you're trading above the 50-day like we are. So we saw a very strong positive momentum and the Hakinyashi still looks very bullish. So we're still good to go from that standpoint. You look at the 3 green arrow chart. We're obviously still struggling to get that MACD. That's why we're so sideways here with the 5 up and 5 down. The MACD's been unable to get above its moving average. You can see that here on the 2-line version of this chart. It's still kind of hovering around its moving average. It's a grind. It's still positive, right? It's still above 0. Stochastics is rising. We're trading in the upper quintile of the range, at least the last 5 days on average. So that's a good sign. That's a good sign as well compared to the 14-day range. We're above the 8-day moving average. Again, even the low point of today's horrible declines, we're stayed up above the 8-day moving average. So again, some context on there too. All 3 lines there are rising. All right, now let's take a look at the intraday chart, which you can see, again, how bullish we are, because you can see how we're trading here sideways today. We're heading into a big earnings week and a big FOMC week. So, but we got all this volume below us that's going to act as a support. You see, there's the Hakinyashi open today for SPY in the weekly candle. Right at, it's one of the biggest volume nodes that SPY has had over the past 4 weeks. So, again, this is an intraday chart, so keep that in mind in terms of how strong support and resistance is. It's generally weaker the smaller the time frame. But still, there is a support there at those levels, and obviously the bigger support down around the 4-week midpoint. That 4-week midpoint is going to start shifting its way up here, depending upon how much we go up to the upside. Once you get below about a 7.5 point range, which is a 2.5% of the high point, that's when you're like, okay, we're getting too tight. That usually signals more of the increased probabilities that would break to the downside. A 7.5 point range, you're looking at about 295. So that's starting that will bring the low point up into this area here. So, we move up without a move up higher to new highs, and that's when the concerns will be for more of an intermediate pullback. Otherwise, as we move up, it allows for more room to go up to the upside without. See, the band stretches once you get to about 5% of that high point. That's when we've really, pushed out that range. It's hard to keep pushing up to new highs when the range is that big on the bullish move, which is about 15 points. So, that gives you, as this moves up, it gives you more room for the new highs to go up as long as you continue to keep pushing. It's like that rubber band. You just pull in and out and in and out. Once you just go too far down, then we end up stretching to the other side, right in the other direction. Or if we pull too much to the upside, then we can get the pullbacks going in the wrong direction as well. And obviously right now we're in either one of those. We're just on the nice steady grind to the upside. Let's take a look at today's volume and range. As you saw, kind of an inkling of the range being less than a half of the average, just over a point, and then the volume also very, very minimal. I mean, these are just extremely minimal numbers, but again, that's the time of year. People are leaving. I'm leaving tomorrow. We're going to be on vacation. You see pictures of people you follow on Twitter. Everybody's on vacation. That's just the nature of the type of market, especially when you're in a bullish market. That's the nature of the time of year and the trend that you happen to be on, and putting those two things together, as well as a higher price, right? As the price gets higher, you're going to have less volume too, because, again, it's the amount of money, it's the money flow, not just the volume itself. That's the bigger deal, and that incorporates the price. You take a look at this volume and range. 38 million is way down here below the average. 1 point is also way down below the average. That's bullish. That's nice and stagnant. It's boring. You get ups and downs. It doesn't seem like we go anywhere, but you just kind of just push up to the upside when you have these low volumes that are just grinding bullish. Eventually, things will pick up, and you'll get bigger ranges and bigger volumes, and up. If we get, we start getting 3.5, 4.5 point ranges. Obviously there'll be down days associated with that, with volume in the 100 million range. Then you'll start saying, okay, now we're looking to, things are going to pick up to the downside for more of an intermediate pullback, and obviously we're not to that case yet. Finally, let's take a look at volatility. Volatility, interestingly enough, as low as the volume is and as low as the range is, volatility is not low. And we all know why, right? We got a big event risk coming up this week, in addition to so many different major earnings announcements. So volatility is nice and steady. It happens to be right at the sweet spot of the bullish range for stocks, right? The bearish range for volatility, right in that sweet spot at 85%. Getting below 80% is the worry mark, and we're not there yet. And getting above 90% breaks the trend. And we're back. Now we're on that intermediate pullback, and we're obviously not there yet. So we're nice and easy in the middle, in the sweet spot. All right, before we transition into what's driving the action and obviously our trade idea of the day, I want to kind of pause right here and just summarize the technical outlook, which is extremely boring, right? That's when you're grinding higher, it's boring, and that's the nature of bullish markets. They are boring. They're hard to trade directionally if you're doing short-term trades, because you're just not getting enough movement. The volatility is not high enough. You're not getting enough movement. But from a trend trading standpoint, they're great. I mean, you can ride nice, boring trends as long as you want, depending upon how much, obviously, time decay you have working against you if you happen to be trading options. So that's where we're at right now. All the signs still point towards this grind higher. And we're not even grinding higher to a euphoric state where we expect that volatility to pick up. It's just not, even though the volatility did pick up today, but we know why, because it's a big week. It just happened to pick up right to the sweet spot of this trending of the bullish trending area that we're in right now, and so that's nice, again, nice and normal and what we expect to see. So what do you think? Do you agree with that or disagree with that technical outlook? There's a link right there popping out in the top right corner of your screen. Click that link and opens up a poll. Hit either agree or disagree. If you click disagree, comment down below. What do you think? What are you seeing that suggests otherwise from what we just came up with here with our daily routine? All right, now let's talk about what's driving the action. And one of the reasons why we're so boring and why we're grinding and not really getting going is because of this strong dollar. Over the last couple of weeks, the dollar's been the best performer. Gold's been an strong performer. Long-term bonds have been a strong performer, so along with preferred stocks. So that's actually kind of a risk-off scenario to see those three asset classes outperforming, not just up above zero, but outperforming stocks. And you also see large cap stocks outperforming small cap stocks, developed markets outperforming emerging markets, and of course gold outperforming crude oil. Lots of different risk-off relationships here over the past couple of weeks, but instead of like producing a 5% decline, all that's done is produce a 0.25% increase over the past couple of weeks. And ultimately we did drop below 1% during that 2-week period, only to come back up lately. So it's a risk-off pattern that we're seeing, but it's this is about when your risk-off moves are sideways. That's kind of the nature. That's bullish, right? That's the kind of a nature of bullish markets. You don't get very deep pullbacks or exhales. You tend to get kind of the flat to sideways exhales like we're getting right now, at least on a near-term basis. There's today's action. You can see crude oil did rally today, which is a strong sign for risk appetite, outpacing gold. Gold rallying up with the dollar and crude oil. So you take a look at its chart. Gold taken off here after a little bit of a pullback here sideways, trying to get back up above this 1450 level. Gold's made a nice run, if you look at on the long-term chart, to break up above 1350, and it's been kind of going sideways. We're still very bullish on gold, and you still got all these upper shadows that we've had on the weekly chart. See, if you look at the regular candles for these, you still have these long upper shadows that act as resistance, especially considering how bullish we are on that chart as well as on the Bollinger Bands. There's that volume node that we just created. We're above the value area, again kind of reinforcing how bullish we are. But go to that 5-year chart and you can see how big the Bollinger Band width is on this little breakout move that we've had. It's gotten it up to a high level, relatively speaking. This is this Bollinger Band width is an apples-to-apples comparison. You see we can still go up to about this 25% area where the bandwidth increases 25% of the price, and there's still some room to move. So we're not completely overextended yet. We've had bigger moves on, like for example, here's one that was to the upside. We've had bigger moves in a short amount of time than what we're seeing. But we've had the surge, and you can see the surge up above the moving average. Now we're just gonna kind of move our way up into an area of very, very low volume, because we didn't have a whole lot of volume in this spot. We came down quickly through this area. We went up quickly previously through this area, and the 5-year basis. Well, that's a 20-year. If you go to a 5-year chart here, let's see if we can. Nope, I need to go probably 10 years to get some price action up above. There we go. So there's our 10-year chart. So again, you see this is where we're heading into, very low volume area because of how fast we move through that spot until we get to about that 1600 level. So again, a rising gold usually means weakness in the dollar, and that hasn't been the case. The dollar really broke out over this past week. You can see kind of getting above 98 and a little bit of a doji type spinning top pattern here up above 98. So we'll see how this holds, how this move ends up holding or not, because again, more of a bullish move on gold doesn't necessarily mean bearishness on stocks, but it does usually mean bearishness on the dollar. If those two are moving up together, then that means that we are in the throes of really bearish investor sentiment, and that's obviously not the case right now. So we'll see how that impacts what the dollar is doing. if you look at the dollar compared to a lot of its counterparts here, you can see how it's really had some struggles. And this is the top 4 currencies that where the dollar is the quote currency. So as this drops, the dollar goes up. And you can see how the big moves the dollar's had versus all these major currencies, especially today, the British pound really dropping significantly, down 5.5% over the last 3 months. That's a significant move for the pound currency. All the other currencies here, you notice, this is a dollar where it's the base currency. So when these lines go down, the dollar is bearish. So you notice the dollar is not really bullish against everybody. It's bullish against one currency in particular, but it's been pretty bearish, well, in the euro too. Everything else has just been more of it's been declining. It's been trending lower, and we just had a little bit of a pop to the upside. The question is how temporary that pop will be. And if it is temporary and gold rallies and the dollar falls, then that's actually going to be a good thing for stocks because especially international stocks, which have been really lagging behind, you'll start to see some of those areas do well. A little bit of a bounce in small caps, but you'll see large caps continue to do well too, considering most of those multinational companies would benefit from a softening dollar. And also keep in mind too, when you look at the dollar index, which is mainly the dollar versus the euro here, let me get this, there we go, and go out a little bit further. There's been some chatter about, well, the dollar, why are we doing what we're doing? Why does the Fed need to cut interest rates? Well, keep in mind how strong the dollar is relative to, its main counterparts. Right? Nothing's in a vacuum when it comes to these, economics and currencies. When we had the credit downgrade, and there was all that chatter about the Fed shouldn't be doing QE3. They ended up settling for Operation Twist at the time. But we shouldn't be doing QE3 because of inflation concerns and the Fed getting, well, you notice how weak the dollar was at that point. The dollar was extremely weak. Since then, the dollar has strengthened pretty dramatically to the point where now it's a little bit, as we've seen, a little bit too strong. It's really been hampering all these global economies and how they've performed. And it's, as you see, it's been slowing down the U.S. economy. Well, in addition, obviously, to trade wars and things like that. So when you look at, currencies have a value in a portfolio, especially a portfolio that has an international component to it. So pay attention to what the dollar's doing, not just on an absolute basis, but what it's doing compared to all of these peers that it has, that it trades against, especially the euro. And then you can see, okay, well, considering how bullish the dollar is, now we see why. The Fed is on a dovish stance because the short-term interest rate might not be very high on an absolute basis, but is very high comparatively to other central banks out there, and makes our policies a lot more restrictive than they are on an absolute basis. Again, this isn't a political video, but the idea being that are we going to be in a more protracted interest rate cut cycle? And I don't think that's the case. The markets are obviously pricing in 100% cut for July, but once you get to the end of the year, we have a 90% cut for a 90% chance for a second cut, and that's pretty high. So we'll probably get a second cut by December, but you can see that's a bigger number than it was. So the odds of a second cut by the end of the year are smaller than they were. And then if you go back to April, and that's again 1, 2, 3, 4, 5, 6, 7 meetings, including this week's meeting. So it's one cut this week that's 100% baked in, and then you have one cut, and you have the odds that you have about a 75% chance of a third cut. So now that's below 80%. It's high probability, so we're leaning that direction, but it's not baked in the cake. It can change very easily, as we've seen. And so there's a good chance that we might not get a third cut. Not a good chance. I mean, there's, again, high probability we will, but it's not baked in the cake. So a lot of things can change in 7 months. So you pretty much have, really high odds of 2, but then after that it tapers off, and it's kind of a wait and see. And I think that's very similar to 95, very similar to 98, where we get 1 in the case of 98, 2, 3 in the case of 95, rate cuts where it's okay, let's see what we need, 25 basis points only, and then we'll kind of go for there. And that was a spark, as I pointed out on Twitter. It was actually Oliver Rennick from TD Ameritrade Network that pointed it out, and here I'll retweet it so that you can see. Essentially, these are the last 4 times the Fed's had an interest rate cutting cycle, and I don't consider these two cutting cycles because they were just one-off patterns. These were the more regular cutting cycles that we had, and so I think we're more into this area, and that those 1, 2, 3 cuts that were sporadic ended up providing the spark. Now, are we going to head into a similar period of the late 90s? Of course, probably not. But the idea being is we're also not headed towards recession in the immediate future either, where we're going to be cutting rates at every single meeting. Interestingly, as risk off as the asset chart looked like, this obviously does not. You can see it's interest rate sensitive, so you have utilities and real estate struggling here to the downside. You also have healthcare down here as well, of course. Earnings driving a lot of this, and news for that matter, driving a lot of this kind of singular action in different sectors. But you also see you have a lot of consumer and cyclical stocks up here. Financials doing well, communication services, technology, of course. Discretionary lagging behind, again, largely driven by earnings type results. But everything else doing really great. Energy being the one big laggard to the downside, but this does not look nearly as much of a risk-off pattern. So again, it just kind of shows that that's typical of bull markets and the type of short-term pullbacks we get in the bull markets. Sometimes sometimes they might go down a few percentage points or 1 or 2. Sometimes they just might be flat, and then we get going slowly and grinding back to the upside again. Alright, so for our trade idea of the day, let's take a look at Facebook, and you can see Facebook has pulled back, a little bit of a dark cloud cover pattern here coming out of earnings. We pull back down towards its moving average, but dropping back below $200. It's got a weak bullish posture or bearish posture despite a rising market sentiment. It's still got it'll be a yellow line tomorrow since we're trading below that rising moving average. And you have a dip in the short-term sentiment, which in the past has been a decent buying opportunity for Facebook, depending upon, of course, how this week ends up going. Let's take a look at its 3 green arrow chart, and you'll see that with this drop today, we got 3 red arrows. And again, on bullish trends, 3 red arrows can be a good bullish signal, just like on bearish trends, 3 green arrows can be a bearish signal. So we'll see if this ends up turning into more of a bullish bounce or something like this. Here's the bullish bounce here, and it took a few days to get going, but or it can turn out to be more of a decline if the broader market turns into more of an intermediate pullback as well. If you take a look at the long-term chart for Facebook, and you can see it's very similar to the broad market. We had the pullback towards the 200-day moving average. It bounced up or pulled back to the 50 now. There's still some momentum. This is where the momentum is now. So we've been a lot more bullish than this in the past. Let's take a look at its Bollinger Bands. And you can also see this pullback that we've had has basically got us down to a little volume node here right at the top end of the value area that we're trading up above. So a pullback towards some support from a volume standpoint. A little dip below the midpoint of the 4-week of the Bollinger Band width into the lower half. We'll see if that ends up turning out to be more like this, where we dip below the lower half briefly and then come back up into the upper half. That would be the expectation according to the trend, of course. The DMIs have really kind of pulled in. So you notice the orange line still below 20. So that's actually where we want it to be to begin with. So that puts the pullback in context in terms of how bearish it is. It still hasn't got the orange line above 20, much less above 25. So that opens up for the bounce opportunity for the blue line to bounce back up above 25, keeping the orange line down below 20, similar again to over in this area. Finally, let's take a quick look here at the 3 green arrow chart. For Facebook, we saw the arrows there, but you see the MACD and stochastic still pulling back, but still in the upper halves of their charts and testing that 30-day moving average. We haven't really converged yet, and again, we'll see if that, like this period over here, ends up being the low point that sets us up for the bounce to the upside. That would be the expectation, of course. So how can we trade it? Well, we want to keep, it's a directional trade, so you want to keep your risk small. So we can look at, there's your short vertical versus the long vertical. If we take a look at the long vertical spread, we can see that we can go out here, knowing that the stock, according to one standard deviation of its volatility range, can jump up to 212 without skipping a beat, heartbeat here. So if we were to come over here to look at buying the 197.5, which as you can see is, whoops, let's go right here. Has got it's almost got the most extrinsic value. It's kind of right on the cusp there. But then go out to the 202.5, which is that mid-30s delta, which as you saw, there's plenty of room above 202.5 for it to trade and still be within one standard deviation. That sets us up for a decent reward to risk ratio, knowing that probably won't take the bulk of this trading. You can see most of your losses occur in the front half. Your second half takes a lot longer. So if you can cut your losses to half of that 200, and now you're getting about a 3-to-1, close to a 3-to-1 reward to risk ratio. So risking ultimately about $500 to try to get a couple hundred. So in this case, we'll put you need a position size around that maximum loss. So keep that in mind. But knowing that again, that you want to keep your losses cut to about half of that maximum, and then as it goes up, and if it does bounce, then we get that 3-to-1 reward to risk ratio to the upside, keeping our exposure to volatility changes and theta very minimal. So we don't, very different than a long call where you have a bigger negative theta working against you. That's why you kind of need it to move. In this case, I want it to move eventually, but I don't necessarily need it to move right now because I don't have time quite working against me yet. Well, all right, that does it for today. Very slow grinding day today. We have a big week coming up, so that's not surprising that we will start off the week typically on the Mondays pretty slow. So again, we'll break down. We'll have market outlook videos this week on Tuesday and Thursday, not on Wednesday and Friday because I'll be out. But we will have a special market outlook webinar for all subscribers of our website, both free and premium subscribers to our website on Wednesday night at 8 p.m. Eastern, 5 p.m. Pacific. So make sure you tune into that, as I showed you earlier in the video how to do that. As always, thanks for watching our video today. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video down below. Also, remember to subscribe to our daily email list, follow me on Twitter, and join our community on Facebook, as well as on marketscholars.com. Have a great rest of your evening, everybody, and we'll see you all tomorrow.